Hello and welcome to the Retirement Planning Podcast, your trusted source for navigating the path to a secure retirement. Your host and guide on this journey towards financial peace of mind is Darrin McComas. On this show, we'll delve into everything you need to know about retirement planning, from investment strategies and risk management to maximizing your Social Security benefits and crafting a resilient financial plan using the bucket plan financial process. Join me as we bring you insights from top financial experts, share stories of successful retirement journeys, and provide practical tips to help you build and preserve your wealth. Let's embark on this adventure together as we strive towards a future where retirement isn't just a dream, but a well-planned reality.
Well, welcome everyone to the Retirement Planning Podcast. I'm Darrin McComas.
And I'm Jason Fox.
We have a special guest today. Heather Schreiber is with us. Heather is one of the top experts in the areas of Social Security. We're very blessed to have Heather join us today. So Heather, thank you again for taking time out of your busy day and schedule to join us. Tell us a little bit about yourself and what you do.
Thank you for having me, both of you. As you said, my name is Heather Schreiber. I have been in the retirement income planning space, helping financial advisors like yourselves and tax professionals work through all of the sort of complexity in the landscape of retirement income planning rules and regulations. And we know I've been doing this is my 33rd year doing that. And we've seen how quickly the rules can change and how hard it is for us to keep up, much less the consumers we serve. So, my passion is helping you better prepare for all of those twists and turns when it comes to tax law, legislation that comes out. We saw the Father Secure 1, and then we saw, the Son of Secure, I call it Secure 2.0, massive pieces of legislation that affects retirement income planning. And then we saw the One Big Beautiful Bill Act, some things there that were tied to Social Security, the senior deduction, that had some misrepresentation of what that really was. Maybe we can talk about that a little bit. And of course, Social Security is a passion that I have, and I do speak nationally on that topic because it is the foundational income source for almost everyone in some form or fashion, whether it's their own retirement benefit, a dependent benefit, disability, survivor. So it's incredibly important to understand, and study after study and survey after survey shows that many people lack critical information when it comes to this income source. And so it's my passion to make sure that everyone is educated and knowledgeable before they go make that important decision.
Yeah, that's awesome. I mean, just think of all the laws that have changed in the last few years. You mentioned Secure Act 2.0, the One Big Beautiful Bill. Seems like, we're financial advisors, we're in this space, and we're constantly having to learn new things and apply it with our clients. I can't imagine just being like a do-it-yourselfer person out there trying to keep up with this. And that's why we love having people like you to consult with and tap into and get training from. So Heather, tell us a little bit, Social Security was originally designed to be about 40% of a retiree's income source, not the whole thing, but what are some common misconceptions that you consistently see with people when it comes to Social Security?
Well, I think that you're right. It's designed to be, and Social Security will tell you in their literature that it is designed to replace roughly 40% of your pre-retirement earnings.
Yeah.
For a lot of people, it's more than that. In fact, some people rely on it for about 90% of their pre-retirement earnings. So, education is critical because the average benefit is just over $2,000 for a retiree. And so imagine trying to live on that. So it's incredibly important that people understand how to maximize their benefits long before they take the benefit, right? So really understanding the critical components of what goes into maximizing that benefit and other sources of income. The landscape has changed of the retirement landscape, right? It used to be everyone had a defined benefit pension plan, right? So that's sort of gone by the wayside. The new regime is a defined contribution plan, right? Where most of the responsibility is placed on the worker to save for their own retirement. And we've seen how everyone has been struggling to make ends meet, right? We've had high inflation. We've had, all kinds of challenges that make it difficult to even save for retirement. And so, you have to look at what other sources of income can supplement Social Security. And it's really important that you start having those conversations long before, and you understand what goes into making your benefit what it is. So, I'd say really starting to educate yourself, align with a financial advisor who can help you understand those points. Don't listen to a friend down the street and says, oh, I filed at this age because whatever. Everyone is unique. I always tell everyone, because people always ask, what's your rule of thumb? What should I do?
Yeah.
Well, it's not realistic for everyone to file at 70, right? We know that 70 is the maximum benefit you can get. That's not realistic for everyone. But it's also not probably beneficial for most people to file at 62, nor is it maybe the right choice to say, well, I'm retiring, and so I'm going to immediately file for Social Security. Believe it or not, there are opportunities that can exist with people that have maybe other sources of income to really leverage Social Security in a better way that's tax efficient. So I'm rambling, but I would say there's so much to consider. It's sort of a puzzle piece that you're putting together when trying to figure out what's best for you. And if you're married, that becomes even a deeper conversation.
Absolutely. Yeah. A lot of people talk about maximizing Social Security, and I do think that's important. We just use a different word, optimize, because optimizing your Social Security, like you said, Heather, there's so many other things you should account for besides just getting the biggest number on that Social Security check, such as taxes and other sources of income that really, I think a financial advisor can help you work through those scenarios and ways you can optimize Social Security and protect your spouse. What are some, common mistakes people make? You keep seeing the same mistakes over and over with people.
A big mistake I see is people not fully understanding how their benefit is calculated. It's the most basic thing that you really should understand. When I ask, or even surveys that ask, AARP just did a survey within the last few months asking, what goes in, how do you become eligible for a benefit? And it was all over the board. I have to have 10 years of work. Well, sort of. So you have to have roughly 10 years of Social Security taxed earnings to get those 40 credits to become eligible at some point in the future for retirement benefits. But people shouldn't stop there, right? Your benefit is based upon your highest 35 years of inflation adjusted earnings that are subject to Social Security tax, obviously capped at the wage base. This year it's 176,100, where your earnings stop being taxed for Social Security. The point is, what happens if you don't have all 35 years? Someone just asked me this yesterday. How does that affect your benefit? Well, Social Security doesn't say, well, you only have 20 years, so we're going to just use those to calculate what's called your primary insurance amount. That's the benefit you would collect if you waited until your full retirement age. They don't just say, we'll take your 20. They say, well, we'll take your 20 and we're going to add 15 zeros. That's significant.
That is.
And the reason it's significant is because I always say it's best to build autonomy, because things happen. If you are married, but then you get divorced and you haven't met the requisite 10 years of marriage to get an ex-spousal benefit, then guess what happens? If you're dependent on a spouse for a benefit, there's a lot of things that go into that. If that's one example, you would lose that benefit. If you're dependent upon a spouse to collect a benefit, and I hear that story, well, there's no point in me going back to work. I'll just collect a spousal benefit. The problem is the rules have changed over the years. And so now, in order to get a benefit from a spouse, that higher earning spouse has to file. And so now you have sort of a conflict of interest. You might want the higher earner to wait a little bit longer to protect both lifetime cash flow for both of you, but also protect the survivor. And that's another area that's vastly confused. So I would say a big one is really understanding how to maximize or optimize your own benefit, because you always want to be as autonomous as you can be so that you're not relying on someone else if circumstances change. So that's the first thing. Again, don't listen to Water Cooler Joe. You are not like Water Cooler Joe. You are in your own situation. You have your own, set of concerns. You may have a different type of assets saved and earmarked for retirement than somebody else, or a different amount. It all goes together. You might be concerned about your health, and maybe your spouse is healthy. There might be a wide age disparity between the two of you. There might be a wide income disparity between the two of you. And that matters, because you have to be thinking about, when you're a couple, how are we going to sustain income until the last of us passes away? So a lot of things go into this. So I'd say, don't listen to other people. Understand the basics of how your benefit is calculated and how to optimize that benefit. And then be careful because people tend to think, what's my break even? I hear it all the time.
Oh, yes.
What's my break even? And of course, it's a good place to start, right? Everyone's like, well, I don't know if anyone would really want a crystal ball to understand, when they're exactly going to die.
Right.
But I get it. They're like, well, how long do I have to live for it to make sense for me to not just file at 62? What if I don't live long enough? But the question also should be, what if I live a long, long life? Would it? And the reality is, that's a simpler question to answer in terms of break even. If you're truly single, you've never been married, the break even, if you're just looking at the law of math, is if you live longer than about 78 years old, you would have been better off from a math standpoint to wait from 62 to your full retirement age. And if you live beyond 82, you actually would have been better off waiting until 70. Well, both of those are far below average life expectancy for both male and female. So you see that people are living longer. And so, do you want to take the risk that, for most people, Social Security is their pension, right?
Exactly.
So it's an important decision.
Yeah, that's a conversation we have with pretty much every client we have, is the risk of longevity and what that means for their situation.
Right.
And with medicine getting better, AI now is also a factor, improving healthcare significantly, in my opinion, in the future. So, yeah, I do think longevity is one of the biggest risks people have. So let's plan for that. And if it happens, great. We can't just look at that crossover point or break even point, like you said.
Right.
Yeah, claiming strategies are obviously a big topic. So, for our listeners that are kind of nearing retirement, what are some of the key factors that they should be kind of considering when they think about claiming strategies?
Well, I think when they're approaching retirement, they should not necessarily assume that retirement date is equivalent to claim date. And of course, people do. They automatically think, well, that's going to be my replacement. And you really have to look at the individual or the couple and really kind of look at everything and say, okay, what do we have here in terms of other sources of maybe guaranteed income? Do they have a pension? Is Social Security the only one? What other sources do they have? Is it a sizable qualified plan balance that's going to be pre-tax, that's going to eventually be taxable when it's taken out? Do they have, what are the other sources of income? What is the income need? And you have to really gauge all of that to really determine, what is the best strategy. So I'd say, there's no one answer to that. You have to really look at, and I know I sound like a broken record, but you really have to look at every situation and look at, what's important to them. I mean, even if they say, well, leaving a legacy is incredibly important to me, that comes into when I would suggest that how they file. I mean, because as we know, if someone has a big fat 401k balance or an IRA balance, what do we know about that? Well, eventually what goes in pre-tax that we save taxes on is going to come out, right? And if legacy is important to them, they're going to leave a ticking time bomb to their children, right?
Yep.
If they leave a huge IRA now to their children, it's going to be coming out in 10 years, most likely. And so they're leaving maybe something they didn't think about. So is there a way to reposition that and maybe leave them a different asset, hold off on Social Security, and kind of work things around? So even that comes into it to me. So, I'd say just really looking at that and getting with a financial advisor that can really help you put all of those pieces together. Because it's kind of like, me thinking I need heart surgery and then me trying to figure it out myself. There's no way,
Yeah.
I'd be like,
right.
oh, we have a
Probably not
problem, Houston,
Right.
And so it really is having someone that can really think about it from the mindset of knowing, okay, well, this could possibly cause this problem, because I will look at a case and say, well, I'll start calculating mentally in my head what the RMDs will be.
Exactly.
Right.
Required minimum distributions, for those who don't know. I will automatically start thinking about that, because that's a tax, that can cause taxes, that can cause Social Security taxes, right? So I'm already looking ahead at that. So I kind of work with financial advisors and say, okay, well, we have to worry about this possible issue down the road. This could cause this stealth tax, like a Medicare premium surcharge. So it all goes together in terms of how we claim, because ultimately what we're trying to do is create lasting, sustainable, tax efficient income. And Social Security, in income that's that foundational income.
Yep.
So
Seems like just about everyone we meet with, new clients coming on, they kind of have these three targets in mind. Either they're dead set on filing as soon as they possibly can at age 62, or they're on the other end of the spectrum. They're going to wait till age 70 because that's the biggest amount that they can file for, or their goal is just to make it to full retirement age. Obviously, 62 to 67, there's a lot of different ages you can file. And when you're married, like you said, Heather, there's more things to consider as well. But again, I think you hit the nail on the head. Working with a financial advisor that's trained in this, but we also have a lot of great software and tools where we can model out different scenarios and look at what are the tax implications if you turn on Social Security at this age, and then those RMDs kick in, and all those things that you may not think of on your own. But when you model it out using some great software, it can really help make the best decision for your unique situation. Another issue that we obviously everything we do when it comes to financial planning, we really kind of see through the lenses of taxation. And you work with Ed Slott, and I've been reading his book that he just wrote, the Retirement Savings Tax Time Bomb. A lot of people don't realize that if they turn Social Security on at the wrong time, it can trigger this tax time bomb. So can you kind of dive into that a little deeper, and what are some things you consider when planning with clients?
Yeah, so essentially what that means is that, well, we'll kind of get into this provisional income. It's called are you talking about the tax torpedo effect?
Yes.
Yeah.
Yes.
Yeah. So what it means is that, if you take, it's how you put your income together. So if you have some income that causes Social Security to be taxable, then the minute you take a little bit more income from, say, an IRA, it causes more Social Security to be taxable, and then the marginal tax rate just goes through the roof. So if you take maybe $1,000 of a traditional IRA, it causes $850 in additional taxes. I mean, $850 of your Social Security to be taxed. So now you've taken $1,000 out, and you're paying taxes on $1,850. It just causes this continued like roll. It's like a drum of continued stealth taxes that continues to be paid. That's why it's so important that you're thinking about that way ahead of when you start taking your Social Security, because we can kind of go back to what is provisional income. And better yet, since the One Big Beautiful Bill Act has passed, I'd like to quickly address
Go for
the
it.
senior deduction. The senior deduction, has been tied to Social Security. And it really isn't tied. It really doesn't eliminate taxes per se on Social Security.
Right.
So the way Social Security taxes, federal income taxes have worked is by using what you've got on the screen is provisional income. Provisional income is sort of a behind the scenes calculation that has to be done to determine if a beneficiary's Social Security, if any portion of it is subject to federal income tax. And that calculation is the sum of three numbers. It's adjusted gross income. So that's before deductions. Okay. Adjusted gross income plus 50% of the Social Security benefits annually that are received by either the individual or the couple. Okay. 50%. And then tax exempt interest. So those that like things like municipal bond interest, the interest on that isn't taxable to them, it's tax exempt, but for provisional income purposes, it's pulled back in. So it's AGI plus 50% of Social Security benefits plus tax exempt interest. When you take that figure, then if it goes above certain thresholds, it can be 50%, as much as 50% can be subject to federal income tax, or as much as 85%. And the thresholds, incidentally, have never changed since they were created in 1983, and the 85% threshold was created in 1993. And they're very small. So if you're single, if your provisional income is under 25,000, you're not going to pay taxes. If it's above 32,000, if it's below 32,000 and you're married, it's not going to be taxable. But if it goes above that, if it's 32, in between 32 and 44, if you're married, you'll pay as much as 50% of those benefits will be taxable. So those thresholds are very, very small, right?
Right.
Yeah.
You'd have to have very small income to not pay taxes on it. And so what happens is you figure out what that taxable amount is, and you have to add it in as a line item to be part of your taxable or your adjusted gross income. It's before deductions. So going back to the senior deduction thing, the senior deduction, Social Security sent out a letter and a press release saying that the senior deduction eliminated taxes for about 90% of people, and Social Security taxes. They since corrected it because I kind of went nutto over it. I was like, this is false advertising, because it concerned me the way it was written, because this calculation for provisional income still needs to be done. Okay. The senior deduction is basically for individuals 65 or older by the end of the tax year. It begins this year. Okay. And it's 65 or older. It only goes through 2028. And it's for people that income qualify. So their AGI, if they're single, if their AGI is 75,000 or less, they get a full $6,000 additional deduction, in addition to their standard deduction, in addition to the age 65 deduction of 2,000, they'd get this additional $6,000. It starts to reduce over 75,000, and it reduces. It's eliminated completely once they go to 100,000 or 150,000 of income. Okay. And if they're married, their AGI is 150,000, and it gets eliminated by 250,000. The point is, so if married couple could get as much as 12,000, but it's not tied to Social Security. So that means that you still have to do this calculation, and you can't toss away your 1099 you get from SSA. That was my big concern, that people would say, oh, I don't have to pay taxes anymore. I don't need to do this. They still need to do it, but chances are it will reduce or potentially eliminate taxes that the provisional income calculation shows they have to report on their 1040. So it is a good thing, but you have to income qualify. And if you're 62 and between 62 and 64 collecting Social Security, you're not getting it. So that's another reason not to file that early. And it only goes through 2028. But there are a lot of provisions. There's One Big Beautiful Bill Act has a lot of deductions, some temporary, but they are also income qualifying deductions. You have to be careful about not missing them because you're doing additional things or whatever. So I wanted to get that out there because there's a lot of misconception. Social Security did reword their press release to correct it. In fact, they did say on the press release, this is the corrected version. So I was happy about that, but they sent this letter out to many income beneficiaries, making it sound as though it eliminated this particular part of Social Security law, and it did not. So.
Well, even our government messes up sometimes.
They do. And I caught it. I was like, no, ma'am, no, we can't do that. So they did correct it. So that was good.
Well, good. Thanks for sharing that. Yeah.
Yeah.
I think a lot of this has to do with those required minimum distributions that are going to kick in for most people at 73, some at 75. That's really going to, if you have a substantial amount in those IRAs or 401ks, it can definitely trigger this tax torpedo.
Oh, it absolutely can. The more pre-tax money that you're drawing in retirement, you're taking a risk, legislative risk. That's what that's called, that changes could occur, right? Right now, the One Big Beautiful Bill extended what was going to sunset, those lower tax rates. It extended it permanently, right? It made them permanent, but we know that permanency isn't always permanent because it could change with the next whoever's in office. So you always have to be prepared for the fact that could change. And so, you have to look at, okay, it's this now, but what could it be in retirement? And the old way used to be, well, people would want to wait as long as possible to when they were forced to take required minimum distributions. Well, now that kind of has to switch, because we are in, we're in crisis in terms of what the deficit is. And so there's the only way to fix that is to increase taxes. And so you don't want to have, that's a risk. I'm sharing this RMD with Uncle Sam, and whatever that tax rate is, I have to pay it. And oh, by the way, that also affects how much of my Social Security is taxable. And oh, by the way, that could also push me into a higher Medicare premium, which people don't think about. So it's all of these sort of, trying to get past these road bombs, if you will, trying to make sure that you at least mitigate that risk, by doing maybe some tax mitigation strategies before you even get to Social Security. One of them would be, how about we delay Social Security and instead supplement income when we retire with pre-tax balances, so that we reduce the risk of the Medicare premium surcharge, or taxing more of Social Security, or trying to sort of solve for it all.
Yeah, exactly.
I know earlier we had talked a little bit about spousal and survival benefits, and that was, I think, before we started recording. So could you maybe talk about that a little bit more? And then also as it relates to divorced couples, and the differences that come into the situation depending on the nuances of the individual situation.
Yeah, so let's start with living spousal couples. There's been a lot of change with respect, and believe it or not, the changes started in 2016. I can't even believe it's been that long since these crafty strategies, as part of the reconciliation bill, the budget bill, and in the dead of night, they slipped in this provision that basically eliminated over time these two strategies that helped couples basically get a little boost to their spousal benefits if they use these strategies. They're both gone, and people still ask me about them and get confused. Can I file for this benefit before this benefit? Can I get a spousal benefit, but my spouse hasn't filed yet? And so this is how it is now, and it makes it even more important to get it right. With spousal benefits, first of all, to get a spousal benefit, you have to be married for at least a year. The other thing that's critical is if you are relying, this goes back to the Social Security autonomy thing, if you're relying on a higher earning spouse to collect a benefit under their record, which you can, dependent spousal benefits are available. And the benefit is the highest benefit you can get is 50% of their full retirement age benefit. It's reduced if you as the dependent spouse take it early, but they have to file. That's the critical thing for any dependent to get a benefit off of a worker's work record. That worker has to file. That has changed. So back in the day, they could do something called file and suspend, and a dependent could claim. That's gone. Okay. The other thing that's misunderstood is that if someone has earned their own retirement benefit, then that benefit will always be payable before a spousal benefit. So Social Security will say, I don't care what age you claim. They will look at the worker's own retirement benefit, and they will compare that to the spousal benefit. If this retirement benefit's higher, they're going to pay that, and the worker, the lower earning spouse, is just going to forfeit the spousal benefit. Okay, they're not going to get it. But if it is if the spousal benefit is higher, they'll pay their retirement benefit, and then they'll top it off with the difference between the two. But they can't top it off until their spouse files, right? So it's a lot more complex. Now with divorced spouses, the amounts are the same, and those rules are quasi the same. You have to have been married for 10 years. Okay, that's the 10-year thing. You have to, if you're the one that's wanting to collect off of your ex-spouse, you have to remain unmarried. If you get remarried, and even if you're collecting that ex-spousal benefit, those benefits will stop while your ex is alive. Okay. The slight difference between when can you collect it is that with currently married spouses, the higher earning spouse has to file, right? In the case of ex-spouses, there is a different rule that if the former spouse isn't yet collecting the benefit, the ex that wants to collect can still claim that benefit as long as their ex is at least 62. and the divorce occurred at least 2 years before their claim. That's called independent entitlement. But the rules are still the same. If I'm the ex-spouse wanting to collect, my own retirement benefit, if I have it, has to be less than what I could collect under my ex. So that's how it would work. Survivor benefits are a huge area of confusion.
Right.
And even the Social Security reps get it wrong. And that brings me to always trust your gut. When you go and you talk, or you in person or on the phone, if you are getting different answers from different Social Security reps, or even from one, and you don't quite, you're not feeling, trust your gut. Do not be forced into feeling compelled to claim when you're not feeling confident in what you're being told, because there's been a lot of turnover. Since COVID, a lot of the long timers have since retired, and now people are being trained. It takes a full year by the Social Security. A former commissioner said it takes 1 year to train them on all of the rules. So you can imagine it's taken me years. I've been studying Social Security for years, and I still learn something new. So you can only imagine. But with survivor benefits, it works completely differently. There, you could choose one before the other. In other words, you could say, well, I want to take this benefit now, maybe take the widow's benefit now and switch over to your own retirement benefit at age 70 if you're younger than that, because your own retirement benefit continues to grow, or vice versa. So just know that if you're in that situation, you're not yet 70 or you're not yet 67, call a financial advisor that can help you really navigate that. It's a difficult time. And if you contact Social Security, I just talked to someone right before this call that was given bad information about widow's benefits, and you just want to make sure you're getting the right information because it's so incredibly important. And what I would say when it comes to married couples preparing for the survivor, if there is a wide disparity in income benefits, I do have a rule of thumb here, is that I always encourage the higher wage earner to wait as long as they can to protect the survivor. Because what happens when one spouse dies is the higher benefit remains. So if you have one spouse that didn't work much, they raised a family, whatever the case was, when one of the two dies, the survivor, and it's usually a woman, right? We tend to live longer. Then she's either your claiming age is going to be the gift that keeps on giving or not. If you filed at 63, for example, that's the benefit she's going to get when that reduced benefit. And she could live another 15, 20 years. And we are living longer. And guess what? Women are the ones that need long-term care services more than men. So there's a lot of things to think about just beyond the right now and the break even. We're thinking about long-term.
Such a good point. And we always tell people, typically when one spouse is no longer there, the expenses don't get cut in half.
Right.
In fact, expenses may actually increase. Especially if the husband passed away, the lawn still needs to be taken care of. The repairs around the house, usually those have to be hired. The surviving widow tends to eat out more, and so just because one of you is no longer there doesn't mean the expenses go down. They typically stay the same or go up. So important to protect.
Well, and the other thing is, you don't think about the year after the first spouse passes. Now the survivor is in a single tax bracket.
Right.
Yeah.
So that's another reason that you should be thinking about tax planning long before we get to this point. Right? You want to make those provision or your income, your other income sources as tax efficient as possible.
Yes.
Right. So that when he or she becomes a single and is playing in a single tax bracket, they just got crunched into a very small bracket compared to where they were before. So all of those things need to be considered.
Absolutely.
Such an unfair part of our tax code, but we could do a whole show on that topic.
Yeah.
We'll kind of wrap up today's episode. This is one thing I'm really excited to ask you and get your opinion about. Recently this summer, Social Security announced that, that the funds are going to run out sooner than they thought a year ago. And we meet with people consistently that come to our seminars and talk to us that they just are going to take Social Security at 62 because they're afraid it's going to run out of money and they'll better just get what they can get before it's gone. Kind of walk us through your take on that.
Well, this is the 14th year in a row that the trustees have warned lawmakers, saying PS at the very end of this report. If we don't do something sooner or later, or if we need to do something sooner or later to avoid making people feel incredibly uncomfortable, whether it's the workers who have to pay higher payroll taxes or whatever we're going to do to fix this. This isn't surprising. It changed slightly from last year. And most of that change, honestly, was based upon an act that was passed on January 5th of this year called the Social Security Fairness Act.
Right.
I call it the Unfairness Act, but that's a whole nother episode. But that act eliminated two provisions, the government pension offset and the windfall elimination provision for non-covered workers who don't pay into Social Security and get a pension for that. And I might be unpopular for saying that, but if you really understood why they existed, you would understand why I'm saying that. But anyway, we paid out millions and billion probably of dollars, and it went retroactive. So it hastened the trust fund insolvency by about 6 months. So that's part of this. So they were about the same, right? So the OASDI trust funds, the combined trust funds, are saying if we do nothing, then we'll pay promised benefits up until 2034, and then we'll have only enough to pay 81% of benefits. Part of the problem with this whole message and the concern among those approaching retirement is understanding what insolvency means. It doesn't mean that Social Security is going to go belly up. It means that we would have to have people stop working entirely for that to happen, because we have ongoing payroll. So that the trust funds are funded through payroll tax for the workers, the taxes collected on benefits, and interest income. And interest income on the investments, the government-backed investments, are actually higher than the taxes. So those three sources are what funds it. And what it's saying is we've run out of reserves, but we're funding it with that, and we will continue to be able to pay promised benefits just from that. So I would say when people say that, they say, well, I'll be grandfathered in. If I take it before that happens, I'll be grandfathered in. They won't touch my benefit. That is not the case. You would never be grandfathered in. However, I will tell you, I don't think this is going to happen. Back in the 80s, we were precariously close to another insolvency issue where they were going to cut benefits within months. And that's when they made the changes, some of which that you recognize. When we used to have full retirement age was 65, we gradually have made it up to 67. That's when the first tier of Social Security taxes at 50% was enacted. That's when the civil service retirement system employees of the federal government who didn't pay into Social Security became the federal employee retirement system, where they do pay into Social Security. So they made those changes at the final hour, and that's what they tend to do. They kick the can down the road until they can kick it no more. And I think that will happen. And I think it will be a combination approach to, the system. They're not going to cut the benefits to America's retirees. I don't believe that's going to happen. I think it's, they're waiting long enough. So it's going to be an issue where they might increase the payroll tax that's, currently at 6.2% by employee and employer. They might increase the amount of earnings covered. Right now it's at 176,100. Medicare taxes cover the entire amount of income, but Social Security isn't. So there's ways that they can change it, maybe change the benefit formula. I don't think that they would ever change this 62. That would never happen, because there's a lot of people that have physical jobs that just can't work beyond that. But there's going to be something. So my takeaway there is don't file at 62 for that reason, because guess what you're doing? Even if it did come to be, you've just taken as much as a 30% cut on your benefit. And then guess what? You're going to get another one. So it's not a good idea. Plus, this is, longevity. This is longevity insurance. So the longer you wait, the better that cost of living adjustment works for you too. So a 2.5% cost of living adjustment like we got this year is going to work far better on a larger benefit at 67 or 70 than it is on a measly 62 benefit. So think about that too. So my takeaway is don't do that, please.
I'm in the same opinion as you. Yeah. I think Jason is too. To me, politicians love two things. They love getting elected, and then they love staying in office. And I don't see a lot of politicians wanting to be on the watch while Social Security runs into a shortfall. Because the biggest amount of people that vote are retiree age
Right.
and really are actively involved in the election. So I think it would be disastrous if you were in office and this did happen. There are some fairly simple solutions to this problem, like you mentioned. So yeah, we advise people the same way. Don't make that emotional decision to file at 62 on that. So, well, Heather, thank you so much for joining us. I think you highlighted just how complex Social Security can be and the importance of working with a advisor that can help you navigate all the rule changes and filing strategies and do it in light of a real financial plan that involves, tax planning as well, like you do. And I just thank you so much for your time. I know I learned a lot.
Yeah, very informative. Thank you so much.
Good. You're welcome.
And if you're interested, check Heather out. She does a lot of things with Ed Slott. I know you have a lot of speaking engagements and you're constantly in the news, and she has a wonderful social security newsletter. And you can check us out. We're at ewadvisors.com, and you can find us on Facebook at Wealth with Darrin as well. So Heather, thanks for your time. Hope you enjoy the rest of your vacation and what's left of this summer.
Yeah, thank you.
Thank you for listening to the Retirement Planning Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or if you want to have a holistic wealth and health financial plan, please visit our website. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors. PCA is an SEC registered investment advisor with its principal place of business in the state of Ohio. Evergreen Wealth Advisors and PCA are separate non-affiliated entities. PCA does not provide tax or legal advice. Insurance offered through Evergreen Wealth Advisors are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information pertaining to the registration status of PCA. Please contact the firm or refer to the Investment Advisor Public Discourse website disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the discourse statement carefully before you invest or send money.